afternoon of content. And to kick off the afternoon of Day 1 IFGS, it is my absolute honor to welcome Sir Jon Cunliffe, the Deputy Governor for Financial Stability at the Bank of England. Sir Jon is also a member of the bank's Financial Policy and Monetary Policy Committees, Court of Directors, and the Prudential Regulation Committee. He is a member of the G20 Financial Stability Board Steering Committee and chair of the Bank for International Settlements Committee on Payments and Market Infrastructures. With specific responsibility over financial stability and the supervision and oversight of financial market infrastructures and payment systems, Sir Jon has been at the forefront of modernizing UK payment systems, developing the bank's thinking on a digital pound, also known as a central bank digital currency or CBDC, and leading the bank's work on innovation in financial markets infrastructure. We are very fortunate to have such a thoughtful and considered champion of innovation at the Bank of England and working with other central bankers across the world. Please give a very warm IFGS welcome to Sir Jon to deliver his much-awaited keynote address.
Yeah, well, good afternoon. Central bankers don't normally get music, so it's a nice experience. Thank you very much. And thank you also for inviting me here today to talk about the shape of things to come. The slot after lunch is normally known as the graveyard slot. A lot of blood sugar sort of going in. People may drowse or want to catch up with their emails. The bad news is I'm a central banker. We don't normally speak for under 45 minutes. The good news is, I've tried to cut it down today, so I'll be about 25 minutes. And also the longer speech, because there's always a longer speech, is going up on the bank's website. So if you feel a bit drowsy, want to catch up on your emails, just lose the plot, basically. Don't worry, you can read it all on the bank's website later on. So I want to concentrate my remarks today on payments and money, by which I mean how we pay for things, and the money that we use to pay for things. Now, these are, or were once, dusty and forgotten corners of the financial system, but they've been completely transformed in recent years, and there's good reason to believe that even more radical change is on the horizon. So I'll focus today on the UK, but many of the trends and technological developments I'll refer to are of equal importance to cross-border systems, and those have lagged far behind domestic payment systems and are really in urgent need of improvement, but that's a subject for a separate speech all of its own. And I'll start with a health warning. Central bankers, like me, are very used to forecasting the economic future. That's really central to our job, and I can say from experience, it's not an easy task. The future, as the last few years of pandemic and war have shown us, rarely behaves as it should. However, forecasting the pace and direction of technological innovation, and crucially, the way it's going to interact with social and economic trends, is an even more hazardous enterprise. Much lauded innovations prove to be complete dead ends or just fail to be adopted. Unheralded innovations emerge at speed, and often it's the unforeseen combination of a number of technological advances that generates really radical change. So against that background, public authorities like the Bank of England, charged with maintaining financial stability and with the regulation of the financial system, we need to be forward-looking for two key reasons. The first is, while we can't be certain how new technologies and social and economic trends will play out, we need to have thought through in advance how the risks might need to be managed. Playing regulatory catch-up with new technologies, once they become established, can be very difficult, as some of the experience in recent years with social platforms and other big techs has demonstrated. And second, we want competition in financial services, and we want innovation. It can increase efficiency, it can increase functionality, and it can increase resilience. Setting out the regulatory approach allows those who want to innovate by providing new and better products and services to understand the risks that need to be managed as they develop those products. It also ensures that innovation is not competing simply by taking higher risks. This approach has been a key element in the evolution and adoption of innovation in payments in the UK in recent years. Faster payments, contactless payments, mobile payment apps, challenger banks, for example, alongside open banking, have transformed the way we pay. It's also stimulated the growth of the UK fintech sector, which is now the second largest in the world. These changes have transformed not only the way people pay, but also the type of money they use to pay. Two types of money circulate in the UK today. The first is public money issued by the Bank of England in the form of physical cash, and the second is private money issued by commercial banks in the form of electronic bank deposits. Now, until relatively recently, the great majority of everyday transactions in the UK were made in publicly issued money, notes and coin. However, as the cost of electronic money transactions has come down, as the functionality has increased, and as our daily lives have just become more digitalized, cash use has declined and commercial bank electronic money has come to dominate payments in the UK. Only 15% of transactions were made using cash in the UK in 2021. The ability to transact in cash, of course, remains very important for a substantial segment of the population, often the most vulnerable. And the Bank of England has been very clear that we will continue to issue cash as long as there is any demand for it. But the recent history and trend away from physical money in the form of cash issued by us towards electronic money issued by private sector banks is very clear. And we should expect that trend to continue for a number of reasons. First, and most obviously, is what I've called the digitalization of everyday life, which is likely to continue. The growth of internet commerce or the use of banking and payment apps, for example, are very unlikely to stop. Maybe I should have used an iPad. Second, there are further developments in train within existing payment systems, infrastructure and regulatory frameworks. Pay.UK is developing the new payments architecture. The Bank of England is well advanced in the build and implementation of a new real-time gross settlement system, the central rail of UK payments infrastructure. And I think, as was announced this morning, the government and regulators have set out recommendations to further develop the open banking framework. But third, and just looking a little further into the future, over the last decade, a set of new technologies have emerged which may have the potential for further transformation in money and payments. I'm referring here to the technologies that have been pioneered and refined in the crypto world as tokenization, encryption, distribution, atomic settlement, and smart contracts. They offer the prospect of what is loosely called tokenization of financial assets, including the tokenization of the money that is used to settle payment, and thereby a more extensive, faster, and more secure programming of financial transactions and of recording ownership. The potential tokenization of money and the development of new ways of transferring it in transactions has major implications for the Bank of England. It's not just that we're responsible for ensuring that payment systems work seamlessly and without disruption in the UK, though that is crucial for financial stability. It is also, and this is more fundamental, because we're ultimately responsible for ensuring that each of the monies circulating in the UK, and at present we have 800 private banks, building societies, and credit unions issuing money, that each of those monies is robust and is uniform. By robust, I mean that users can have confidence that the money they hold will be usable and will be acceptable in transactions. By uniform, I mean denominated in the same currency unit sterling and seamlessly exchangeable for any other money in circulation on demand and without loss of value. And against that background, I want to look at 4 examples where the tokenization of money is now being explored. Stablecoins, the tokenization of commercial bank deposits, the Bank of England's work on issuing a digital pound, and finally our approach to what is called a wholesale central bank digital currency. Stablecoins are probably at the forefront of developments in the tokenization of money. Broadly speaking, they comprise a financial asset that purports, by one means or another, to maintain a stable value, and a ledger system for recording and transferring the ownership of that asset. They're supported by exchanges for trading the coins and wallet arrangements for storing them. They're issued by a variety of non-bank entities, and so far their use has been confined to facilitating trading and other transactions in the world of crypto assets. But there are proposals to introduce them for other payment purposes in the economy and for cross-border use, and that would be in competition with the money that is issued by commercial banks and with conventional payment systems. The Financial Services and Markets Bill, currently completing its passage through Parliament, will give the Bank of England powers to regulate operators of systemic payment systems using digital settlement assets, which include stablecoins, for payments at systemic scale in the UK. We plan to consult later this year on the regulatory framework for stablecoins. That framework will cover the issuance of stablecoins, the systems for transferring the coins from one holder to another, and may well also extend to systemic service providers such as custody wallets and exchanges, which are an intrinsic part of the stablecoin arrangement. The regime will give effect to two expectations that were set in 2019 by the Bank's Financial Policy Committee. The first is that stablecoin payment systems should be regulated to standards equivalent to those which we apply to traditional payment systems. And the second is where stablecoins are used as money for payments, they should meet equivalent standards to those that are met by commercial bank money. We'll follow the guidance on the relevant international standards set last year, including the requirement that the coin should be redeemable from the stablecoin arrangement in fiat money at par value and on demand. This matches the requirement for commercial bank money and is crucial both to secure confidence in the coins and to secure their uniformity with other forms of sterling money. Systemic stablecoins will need to be backed with high quality and liquid assets to be able to meet those expectations and standards. And those assets could include either deposits at the Bank of England or very highly liquid securities or some combination of the two. And we're currently considering which of those options is the most appropriate. In considering this, we'll take into account two important factors. First, unlike commercial bank deposits, it will not be possible, initially at any rate, to give stablecoin holders any industry-funded protection against failure. And that reinforces the need to ensure that the backing assets are at all times sufficient in value to meet redemption requests. And second, the underlying objective of the legislation and of our regulation is to open further the frontier for safe and sustainable innovation and competition in payments. Stablecoin business models should in general reflect this and be grounded in improved payment efficiency and functionality rather than maturity transformation of the backing assets. There are other important questions to be resolved, such as whether there should be limits, initially at any rate, on stablecoins used for payments. Our current assessment is that over time, the financial stability risks should be manageable, including risks arising from the impact of the introduction of stablecoins on the banking system. But we can't know for certain the extent and the speed at which payment stablecoins might be adopted, and we may well need limits, at least initially, to ensure that we avoid disruptive change that could threaten financial stability. And finally, on stablecoins, it's really important to emphasize that the powers in the bill and the regime that we will introduce will be for stablecoins used for payments. A digital representation of an asset with a generally stable value could be used for other purposes. It could offer a return as an investment for a return product akin to a money market fund, or it could be part of the credit creation process with lending in the form of stablecoin issuers. I should say neither of those models is at all likely to fit within the regulatory regime for payment stablecoins, though they may fit within other regulatory regimes, such as the regime for investment products or the regime for banks. This brings me to the second area, the issue by commercial banks of new types of digital money to be used on new payment rails in the form of tokenized bank deposits, which some banks in the UK and other jurisdictions are exploring. Tokenized bank deposits could offer some, or perhaps all, of the functionality and efficiency that's been claimed for stablecoins, allowing bank deposits to compete better with non-bank payment coins. In regulatory terms, the tokenization of bank deposits is a much simpler proposition than non-bank stablecoins. Bank deposits are already uniform, robust money in the UK. Indeed, bank deposits account for 85% of the money in circulation. We have a comprehensive regulatory regime, we have deposit insurance and resolution and insolvency procedures to protect bank depositors. Nonetheless, the tokenization of bank deposits does raise some important questions. Currently, money that is issued by a commercial bank can only be held by somebody that has an account at that bank. It's not directly transferable from one holder to another. And in order to transfer money from the holder of an account at one bank to the holder of an account at another bank, there needs to be a transaction between the two banks, which ultimately settles in Bank of England money across the books of the Bank of England. New ledger technology developed in the crypto world could well allow tokenized bank deposits to circulate freely in what might be thought of as digital banknotes issued by private banks. They would constitute claims on the issuing bank that could be held, for example, in a wallet without the holder having to have any account at the bank that's issued the tokenized deposit. And that raises some difficult issues, such as how deposit insurance would operate in the event of the failure of the issuing bank. And it also raises questions about the operation of anti-money laundering and other regulation to prevent illicit finance. An alternative to allowing tokenized deposits to circulate freely in that way would be to require transactions on new forms of ledger, for example, transactions in smart contracts involving tokenized deposits, to be settled ultimately by the adjustment of bank ledgers, as happens now. In other words, a transfer of tokenized bank deposits on one set of ledgers would trigger the adjustment of the individual's bank account balances and be settled by a transaction between the banks involved. In that case, deposit money issued by a bank could only ever be held in an account of that bank, whether that deposit money is tokenized or not. So it's important that as we develop the regime for payment stablecoins, we also develop the requirements for tokenized bank deposits. That would allow banks and non-banks alike to understand clearly what is possible and what is required in the respective regulatory regimes. The PRA intends to set out its approach in this area alongside the bank's consultation on the payment stablecoin regime. Of course, it's possible that commercial banks might wish to offer payment stablecoins as opposed to tokenized bank deposits. In such cases, I think we'll need to be very alive to the risk of confusion on the part of customers as to the protections they're entitled to and to the confusion of very different business models within the bank itself. There are, I think, strong arguments to keep these two models separate and to require banks that wish to issue payment stablecoins under the new regulatory regime to do so through legally remote and otherwise distinct entities. I want to turn now to the third potential development, the issue of a central bank digital currency for retail purposes. As many of you know, the Bank and the Treasury published a consultation paper in February on the digital pound, a sterling digital currency that would be issued by the Bank of England for general purpose retail use. Now, no decision has been taken to implement the digital pound, but our assessment is that it is likely to be needed if current trends in payments and money, some of which I've been discussing, continue. And that assessment rests on two main considerations. First, again, is the need to anchor the value and robustness of all monies circulating in the UK. Physical cash issued by the bank plays an anchoring role at present in a world in which only commercial banks issue private money. If future trends continue and cash use declines further, and if at the same time new non-bank players enter the scene issuing private money as stablecoins, physical cash may not be able to play that anchoring role. In such a world, the right of the holder and the obligation of the issuer to convert all money into Bank of England digital money, the digital pound, at par and on demand, would secure the anchor currently provided by physical cash. And the second consideration is to ensure that there can be maximum competition and innovation in the development of new functionalities using tokenized money. Given the network externalities around money and the likely cost to developing robust and risk-managed private tokenized money like stablecoins, it's possible that the development of digital settlement assets, digital money, will just converge on a few large players who will dominate and perhaps control innovation in payment services. So the consultation paper proposes a platform model for the digital pound, in which the digital pound will be available to a wide variety of private sector innovators who wish to develop payment services using tokenized money, but don't wish or are not able to issue their own tokenized settlement asset or stablecoin. There are many other extremely important considerations about the possible introduction of a digital pound, such as privacy and financial stability, and they're discussed at length in the consultation paper, and I don't want to go into them in detail today. Rather, I'd ask those in the room who are interested in payments innovation to read and respond to the consultation which closes in June. In the next phase of work, which will lead to a decision on whether or not to proceed to launch a digital pound, the bank will work with the private sector on further experimentation and on proofs of concepts, and will work together on developing the technical blueprint for the proposed model. Finally, the digital pound is envisaged as a general purpose retail currency for use by households and firms in everyday transactions. The bank is often asked why we are focusing on developing a retail rather than a wholesale digital currency, given the potential for those new technologies around tokenization, encryption, smart contracts, atomic settlement, to transform wholesale financial transactions. There is bluntly a misunderstanding here of the bank's position. We recognize very clearly the potential transformative effect on wholesale financial markets of those technologies. Indeed, the bill now going through Parliament will enable us, with the FCA, to set up a sandbox in which developers can explore ideas like collapsing trading and settlement into a single, instantaneous smart contract. And of course, for financial stability reasons, we want large wholesale transactions to settle in central bank money to the maximum extent possible, because that's the safest settlement asset in the economy. The question is not whether, but how we should develop the machinery for tokenized transactions to settle in central bank money. So one way forward would be for the central bank, the Bank of England, to tokenize wholesale money, Bank of England reserves, that we issue, and to develop a ledger system for transferring the tokens between the wholesale players that have access to our balance sheet. And we, like other central banks, have been exploring such options, including for cross-border multi-currency use. But there are other options. One would be for a trusted private sector network, to hold an account with us and to tokenize the reserves and to operate the ledgers and transfers within that account. In 2021, we introduced the option of the omnibus account at the Bank of England to facilitate the private sector development of such networks, and there are private sector proposals in progress to introduce them, including for cross-border multi-currency use. Another possibility would be for a tokenized ledger, including a distributed ledger, to be securely and instantaneously synchronized with RTGS, our real-time gross settlement system. Now, that's not possible today with the current generation of RTGS, but we're now well advanced in the implementation of the next generation of RTGS, which is expected to go live next year. This will have the potential for such synchronization, which we're now actively exploring with the London Centre of the Bank for International Settlements Innovation Hub. At present, given where we are in the UK on the imminent implementation of a vastly more capable RTGS system, such options look to provide the faster route to settlement of tokenized transactions in central bank money. And we're working with industry on how best to exploit the possibilities of the new RTGS system. But we will, of course, also remain very closely involved with all of the other options. As with retail payments, it's difficult to forecast now what will prove to be the more successful approaches. It's most likely that, and this is not uncommon with technological development, a range of approaches will eventually be implemented and will coexist. We have a variety of payment systems, both wholesale and retail, of different vintages operating in the UK today, and I'd guess that in future, as new technologies take hold, we'll see both more innovation and more variety. Changes in how we pay for things and what type of money we use is an exciting area of possibility for the fintech world. It's also a fundamental issue, as I've explained, for the Bank of England, as a regulator, as a provider of the central high-value payment system, and as the issue of the highest quality public money in the UK. We aim to be forward-looking, both in developing the regulatory frameworks and developing the public systems and the public money necessary so that safe innovation can flourish to the benefit of all. Thank you.